Well, we're now joined by Pedro Antunes, Chief Economist at the Conference Board of Canada. Pedro, good to see you. Thanks for being here.
It's a pleasure.
So the bank has decided to hold its overnight rate at 5%. Obviously, I think that will come as good news for many debt and mortgage holders. But is that good news for business?
Well, I think higher rates generally are good for banks. The chartered banks do earn a little bit more when interest rates are higher. But in general, businesses are feeling the crunch of essentially higher prices, just like households. They're certainly feeling a lot of cost pressures from wages coming up, and businesses borrow as well as do households. So I think this is taking its toll as well on essentially business investment and the cost of funds for businesses. So I don't think this is a good news story writ large, therefore, for the business sector in Canada.
Because the rate, again, being held, not coming down. But, part of the reason for holding the rate is the argument that past policy decisions are still making their way through the economy. What exactly is the bank watching out for? Because there is one more decision to be made before the end of the year.
Yeah, I do think that, as you mentioned, the fact that rates are now at very high levels are well above where the bank considers. So, again, we don't quite know what a normal rate is anymore, but certainly the bank had made mention that a neutral rate would be between 2% and 3%. So we're far above that on the short term. This means that the brake is still firmly on the economy. It's having the impacts, as we just discussed, on households and businesses. And we're seeing the success of that in the sense that we have seen the economic growth slowing. In the second quarter, it was slightly negative. Certainly, we're tracking for the third quarter to be slightly negative or essentially flat. So we're slowing the economy, and the hope is that we'll continue to see inflation heading down that downward path and essentially heading towards price stability. I think the bank is very concerned about a lot of the essentially a lot of the external pressures that are still very real, and they made certainly a lot of mention around some of the risks that could see oil prices, for instance, come higher.
Interesting you say that, because I was going to ask about oil prices, because obviously the bank also says, yes, oil is something that we need to be wary of, but they're also wary about the conflict between Israel and Hamas as potentially complicating the picture. How might those actually affect the last rate decision of this year in December?
Well, I still think we're probably going to see the bank hold unless something really kind of drastic happens. But again, we saw this essentially in 2022 when the war, when Russia invaded Ukraine, and we saw a massive commodity price shock that affected not just oil, but affected a lot of commodity prices, and led to another layer being put on already hot inflation across the world, around the world. This is a similar situation here. I mean, if this war that's going on in the Middle East expands beyond the current conflict, we could easily see, and markets, in fact, have already been very nervous, and we've seen that affecting kind of oil prices on the up and down. So if there's something here that spreads beyond those borders, we could certainly see certainly an oil price shock. And let's not forget, oil is essentially an input into a lot of the production processes across the world. The supply chain is key input. And it also affects transportation costs, and most directly for households, gasoline prices. So all of these things would, potentially add another layer of inflation to the battle that the central bank is trying to win here, trying to get those inflationary pressures down.
Yeah, and as you say that, there is a statement that was made in the release from the Bank of Canada governor today, and this is what it said, quote, "The bank's preferred measures of core inflation show little downward momentum." What exactly is being referred to here? Is that concerning?
Well, the core measures really look at what's happening domestically. They try to exclude very volatile items like food prices and energy prices, for instance. They also try to exclude things like tax changes and other measures. So essentially, the problem here is that core inflation is being driven by kind of the service sector side of the economy, and we know that wages are coming up quite strongly. I think the bank is very concerned that wages essentially running at 5%. That's not in line with a 2% inflation environment. So we've seen, despite the fact that we've seen top line inflation up and down, and in fact in the last couple of measures it's come down in part because of kind of easing prices for durable goods and for oil as well. When we look at kind of the underlying measures, the underlying domestic wage pressures, they're still kind of running well above where the bank would feel comfortable with. So this is, I think, in the messaging that the bank is sending, this is the sense that we're going to have this kind of longer battle to get inflation, core and otherwise top-line inflation, down to that 2% target range, and the bank, I think, is trying to prepare us for that.
Okay, so longer than perhaps most people would like, and I think that really is ultimately the big question for many people. When do the rates start going back down? Because based on what the bank had to say today, it doesn't look like that's going to happen anytime before 2025.
Yeah, I mean, I think still this would be kind of the good news scenario in that we slowly get inflation back down to that 2% range. It does take a long time, but we don't have, kind of a massive downturn in the economy. And that plays out in this kind of soft landing scenario that I think most forecasts are looking at. And so in a way, it's kind of a good news. It's kind of a slow, stable kind of trek to that 2% range. But it is going to take and continue to take its toll, as we just discussed, on businesses and on households. We know that most households have not yet felt the pinch of essentially renewing their mortgages with these higher rates. And in fact, only about a third have seen the impact of that as yet. So there's a lot of, I think, further pain to be felt, unfortunately.
Okay. Well, not good news to end it on, but of course, always good to know the information as it is. Pedro, thank you for this. Appreciate the time.
You're welcome. It's a pleasure.